minutes. I'm sharing the screen. Can you see the screen? Hello.
No, sir. Yes, sir, I can see
Okay.
the screen. Sorry.
Okay. Just like let that recording start 2 minutes. Then today I'm having bad time with this connection also. Okay. So here you can see this was the data which we were sharing. X of user straight line depreciation for financial reporting and accelerated depreciation for income tax reporting. X of tax rate is 30%. Compute X of income tax expense and income tax payable. Very simple question. Let's do this. So now this is income tax. This is income statement, and then we'll prepare a tax return also. Okay, and we'll see the difference. So revenue 10 lakhs, depreciation straight line for financial report preparation. Other expenses are this, income is this, 30% tax on that. This is income tax expense. Okay. Let's see the tax return. So 10 lakhs and again 3 lakh 20 the depreciation, accelerated depreciation and other expenses. This is income and then 30% this is income tax payable, and you always pay taxes on this. Okay, so in the sense this income and then into tax rate has given you income tax payable. So this 9,000 is what you should pay to the government. 45,000 is the provision you have created. Got it, Smriti? So you have a higher provision and you pay less. So DTL is created in this case. That's very clear. So you can see this. The deferred tax for period of 36,000 is the difference between income tax expense of 45,000 and income tax payable of 9,000. This is a deferred tax liability because you paid less, supposed to pay this much more. So the journal entry, your income tax expense is 45,000, debit all expenses. Your liability is 9,000, which is the current year liability because income tax payable is current year liability. And this is your future liability, deferred tax liability, 36,000. And this is a current liability. This is a non-current liability because you will be paying in the future. Okay. So today I would stop here, Smriti. It's too late. I know like the class has happened in bits and pieces. Okay, then no problem. Let's continue for more time. So now the temporary differences also I have explained you. Often the difference between pre-tax accounting income and taxable income taxable income results from items entering the income computations at different times. Of course, I said you like because of timing differences, because when you prepare financial report, you recognize something early. And like when you prepare tax returns, you recognize when you really receive the cash in the future. So since the transaction recognition has happened at different times, that creates timing differences, and these timing differences are also called as temporary differences, and that creates deferred tax asset or liability. Let's see. So here temporary differences will reverse out in one or more future periods. That also will see an example. When your accounting income is more than taxable income, deferred tax liability is created and future you need to pay taxes. When your income tax when your accounting income is less than your taxable income, deferred tax asset is created and future deductible amounts. That means in future, whatever taxes you would be paying, you would get a refund on those taxes, or that those taxes would be reduced with the excess tax what you have paid. Okay. So now you should understand what I am going to explain here. These are revenues or gains. These are expenses or losses. So if I speak about installment sales, so in installment sales, what happens in installment sales? Let's say accounting profits, tax returns. See, in installment sale, we recognize the entire revenue at the beginning, and here we recognize the revenue when we receive. Here we recognize before, and here we recognize later. And since we have recognized before, our accounting profits are higher, and here the taxable profits are less. So when accounting profits are higher, your income tax expense would be higher, and your tax liability would be lesser, and there is a deferred tax liability created. Okay. Now, unrealized gain from recording investments at fair value. So what is this unrealized gain? That means you haven't received cash, but you have earned it. So since you earned it, you showed it. Unrealized gains. You showed it. Since you showed your income, your accounting profits are higher. Your income tax expense is higher. That creates your taxable profits are less. Your tax liabilities is less. That means you have to pay more tax. That means you have paid less, and you need to pay some more in the future. So deferred tax liability is created, and I will prove you this fact here. So the temporary differences in the yellow boxes create. So this is, they are speaking about yellow boxes. I'm speaking about blue boxes. Okay. Smriti, is it clear to you?